Hi there. Financial reporter Karyn Bale here, hosting today's show, The Real Deal, brought to you by iTulip.com. iTulip, forecasting the political economy since 1998. Today's guest is Federal Reserve Chairman Ben Bernanke. Chairman Bernanke, thank you for joining us.
What the hell? How did I get here?
You are on The Real Deal. We grabbed you through the Real Deal portal. We're here in front of the Magic Kingdom. We thought it was fitting.
What?
It looks charming, if you're a child. Same with the stock market. That's what we want to talk with you about today.
I was in the middle of lunch.
Sorry about that. At least you weren't in the shower. We won't be 10 minutes. Do you want a snack?
No, I don't want a snack.
All right then. Let's get on with the interview. First, we'll inject you with truth serum.
Ouch.
Wednesday, the Dow Jones soared 250 points and yesterday another 100. Most business reports attributed the rally to progress made toward the resolution of the European debt crisis. But this is at least the fifth European sovereign debt crisis rally since the crisis began in Greece in early 2010. Since then, the debt crisis has grown to include Ireland and Portugal. Everyone seems to forget the sequence of events that led up to the sovereign debt crisis. Each rally is reported in isolation and without context. Isn't this an escalating, not a de-escalating process?
That's right. The sovereign debt crisis in Europe today is rooted in the U.S. housing bubble that started in 2002 and ended in 2006. After the housing bubble popped in 2006, the U.S. securitized debt market crashed in 2007. That was followed by the failure or near failure of major financial institutions. Then came the financial crisis in 2008, then the private credit market crisis, then the emergency Fed bailouts of financial institutions, then the global economic crisis as the private credit markets froze up, then the $2 trillion in fiscal spending programs worldwide to stimulate the economy. Then the fiscal crisis for those countries that couldn't afford the debt they already had even before the crisis. They are the first to succumb, but they won't be the last. We are talking about an 8-year-long process here, 8 years and counting.
That's way too complicated. Can't you make up a primitive explanation that is totally wrong but is easily understood by a 5-year-old? Take into account the fruit fly memory of the average finance and economics news consumer.
Hell, the problems go back much farther than 8 years. The volatile sideways movement of stocks we see today is a continuation of a decade-long process. The 1 step forward, 2 steps back of the stock market is nothing new. Whenever you hear about the stock market today, you have to remember that stocks are still 20% below the level they were at in 2007. Bonds and especially commodities and gold have far outperformed stocks since the year 2000.
The truth serum is taking effect.
The even worse news is that the stock market is still not even close to the nominal price level it was at 10 years ago. But the truly awful news is that in real inflation-adjusted terms, stocks are off 25% over the past decade. This horrific state of affairs is so rarely reported that 99% of the American people are unaware of it. Instead, completely irrelevant metrics like the 11,000 level for the Dow Jones Industrial Average make the headlines day after day, week after week, year after year, so that's all people know, but it's crap.
Net it out for us. Our attention span is limited to the time it takes to eat a Twinkie.
Look, the only relevant fact you need to know about the stock market is that if you bought $100,000 of an S&P 500 index in the year 2000, you now have only $75,000 in purchasing power left. A major loss. If you bought $100,000 worth of gold instead, you now have $415,000 in purchasing power. It's a fucking scandal. The rest is bullshit.
And that, folks, is the real deal. Ben, it's been great to have you on our show.
Can't I go back to my lunch now?
Yes, and after the truth serum wears off you can go back to making obtuse comments about inflation and unemployment. And that concludes another segment of The Real Deal. Next week we'll have Ben back on again to explain, after we inject him, how he plans to continue lying to the bond market about inflation as spiking gasoline and food prices work their way into finished goods prices early next year. Thanks for joining us. Until next time, Karyn Bale for iTulip.com, signing off.